How do you gift a home without anyone paying taxes? Maybe you have a second home that you're looking to give to your child, or you're thinking of ways to leave your personal residence to your heirs when you pass away. In today's video, we'll talk about what types of taxes could you be potentially paying, how do you gift a house while you're still alive, and how do you gift the house when you pass away. When we're talking about gifting the home and we're talking about taxes, we have to look at what type of taxes are we talking about. The first would be income taxes. Is anyone going to pay income taxes if we gift the home? The answer is no. When you gift property to someone, the property that is received by that person is not income, so there would be no income tax paid on the gift of a home. Would we have to pay gift taxes? Gift taxes are when someone gives money or property to someone else. But there are several exclusions that most likely would qualify for no gift taxes being paid. Let's first look at how much can we gift to someone each year without any gift taxes paid or any special forms required. This is called the annual gift tax exclusion. Let's take a look at an example. Let's say a parent is looking to gift money to a child. Well, that parent is able to gift $18,000 annually to that child tax-free, no gift tax, and also with no extra paperwork involved. This is what's called the annual gift tax exclusion. So now let's take a look at if the spouse is married and the child is married, how can we extend the annual gift tax exclusion using something called gift splitting? So if the current parent wants to gift the child $18,000, they can do that. If the parent has a spouse and they want to gift $18,000 to the child, they can do that. What if the child has a spouse? Well, the first parent can gift $18,000 to this child's spouse, and then the married spouse can gift another $18,000 to the child's spouse. So a married couple can give another married couple up to $72,000 while utilizing the annual gift tax exclusion and gift splitting. If you are doing gift splitting, the only thing you'll need to do is file a gift tax form with your income taxes at the end of the year. So what if we give more than the annual exclusion and more than if we use our gift splitting? Well, then we're eating into our lifetime exclusion amount for gift and estate taxes. But that is currently set at $13 million per person. Now that is scheduled to reduce in 2026 back to $5 million per person. But as long as your overall net worth is below $10 million, this is probably not going to apply to you. So gifting the house most likely won't qualify for really any gift taxes being paid. So what about estate taxes? Well, federally, that same $13 million applies to estates with assets over $13 million per person. And depending on your state, you may or may not have to pay estate taxes. So New Jersey no longer has estate taxes for Class A beneficiaries, such as direct children or grandchildren. Now, if you're giving property in an estate to a niece or a nephew, they might be subject to an inheritance tax. But for children and grandchildren, there's no estate taxes in New Jersey, so we don't really have to worry about estate taxes either. Really, the final tax that we would need to consider is capital gains taxes. So since a home is a capital asset, you are only paying taxes when that home is sold. And if there's a profit, you are paying capital gains. And if there's a loss, you're paying capital losses. So if you don't sell the property and your child doesn't sell the property, again, there's no taxes paid. But we should talk about what happens if the child does decide to sell the property. And this is what the difference is between gifting the home while you're alive or leaving the home in your estate. So if you're going to be gifting the home while you're alive, the cost basis of the home is going to be transferred to the child. So what's the cost basis? The cost basis is how much you paid for the home and all the capital improvements that you've done in the home. You only pay taxes when you sell a capital asset, when the difference of the value at date of sale minus the cost basis. So if your child receives the home while you're alive and receives a transferred basis, if that child decided to sell the home at any point, they would pay capital gains on any net capital gain. Now let's look at the difference of if you gave the house when you passed away. Well, if you gave the house when you passed away, there's something called a stepped up basis or a stepped up cost basis. So what ends up happening is at your death, if in your estate you choose to have the child become the owner of the home, the child will receive the home, but the cost basis gets stepped up to the date of death value. So now if that child did decide to sell the home at that point or any point later, they have a much higher cost basis. Now you can see the value stays the same, but the capital gain taxes are greatly reduced. So let's go through some of the pros and cons of gifting the home while you're alive. Well, the first would be the kids get to call the house their own, and you get to see that. And for some people, that's really important. Second, you will lose in the expense of maintaining that home. Hopefully now the kids are paying for the taxes and the maintenance of the home. And third is you're going to reduce the likelihood of anything being contested or anyone having an issue at death with the home being transferred to the kids. Now the cons of gifting the home while you're alive are, of course, you're now losing a resource that you could have sold and used for your own benefit. If you were getting rental income from that property, you will no longer receive that rental income. And the third, as we talked about before, is that there's a transfer of basis as opposed to a stepped up cost basis when giving the home while you're alive. Some of the pros and cons of leaving the home in your estate to your child when you pass away is you maintain the income of the home if there's rent being paid. You maintain the asset that you could use if you ever did need it. And you would have a stepped up cost basis at death, meaning that the children would have much less unrealized capital gain down the road. Now, some of the cons are you potentially would maintain the expense of the home. There could be a contest of the will if the home was being probated in your estate. And the kids may not feel like the home is truly theirs, especially if they're living in it. Now, something to consider and to talk to your advisor and your attorney about if you decide that you want to maintain control of the home, but you want to have more control of what happens when you pass away. You could use what's called a revocable living trust. A revocable living trust is simply a legal document that you are the trustee of, which means you're in control of whatever assets are inside the trust. And since it's revocable, you can change and do really whatever you want inside the trust. The key part is that you are able to name the successor trustee if you were to pass away, and also the beneficiaries of whatever assets are inside that trust. So what some people do is they retitle the home into the revocable living trust. And what that can do is maintain the ability for stepped up cost basis. You maintain the control of the home, but it's a much clearer pathway for when you pass away, because a revocable living trust does not need to go through probate of an estate. Some other issues to consider when you're gifting property are that there are Medicaid look-back provisions. So if you're doing this in an attempt to get Medicaid faster, you'll need to talk to an attorney about elder care issues and how gifting property can affect Medicaid. There are things called life estates, where the person can maintain residency in the home but potentially gift ownership. And there are family considerations when you're gifting the house, especially if you're gifting the house to one sibling. How are the other siblings going to feel? Or how are you going to potentially true it up in your estate? So these are all things that you need to talk to your advisor, talk to your attorneys about before you actually make a decision. Hopefully this video was helpful and it helped provide some education about the different types of taxes to consider. Please consult with your financial advisor and your attorney about what is the right strategy for you, and talk to your family about what you're ultimately looking to achieve. But the takeaway here is that unless your net worth is $5 million, $10 million or more, you're probably not going to pay really any taxes when you're gifting a home, let's say to a child. My name is Nick with Supportive Financial, and thank you for watching. Take care.